Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we are back with another episode of the Real Estate Investing Club. I hope you guys are having a great day, great week. It is still the beginning of the year, so I hope you guys are crushing it already, getting off to a good start. I know I have, at least I got my workout in, so that's what matters most. It's still kind of early in the day, and it's only the second day of the year, so we're doing good so far. But it's a good day for a second reason, because we have Mark Khuri with us on the podcast from SMK Capital Management. Mark is SMK Capital Management. They are a private equity firm in real estate. So all you guys, if you're interested in the investing side and not necessarily the active GP side, but understanding how things work on the top level, finding sponsors, that kind of thing, then this is the episode to listen to. So Mark, I am super excited to jump into it. Thanks for hopping on.
My pleasure, Gabe. Thanks for having me.
Absolutely. I told you before we got on here, we always like to start with stories. We like to hear how people got to where they are. So why don't you take us back to the beginning of your story in real estate and tell us how you got here?
Sure. Yeah, I'll keep it brief, Gabe. But my real estate beginnings kind of started when I was a kid. My father and mother owned just some apartments in upstate New York, where we're from. And it really started by counting the coins on the family room floor at night from the laundry machines, right? And so nice. We'd have to put them in the sleeves so you could deposit them in the bank, right? This is probably in the 1980s. So it's been a while, but it's always been around us. And I actually got my formal start in 2005 before the recession, started investing in real estate, predominantly single family, residential, small multifamily. Partnered with my family members for a few years, buying mainly distressed assets, Gabe, directly from the bank during that time through the 08, 09 recession. This was all while working full-time in finance. And we built a small portfolio by 2010. You know, I was hooked into real estate, left the W-2 in the finance world. And, you know, that's 15, 16 years ago now. And so the rest is history, as they say, but that's really the beginnings and how we got started, and then formed our company in 2010, SMK Capital Management. SMK is my father and I's initials. So we partnered and, kind of grew up into the more commercial real estate space that we invest in today.
Very cool. Yeah. And when you hear about the 2008, 2009 time in history in real estate, there's always there's the good and the bad stories, the people who were kind of, they were overexposed in that time and they had a rough go at it. But then there was also the people who realized the opportunity, saw what was there and took advantage. So it sounds like you guys really had a good opportunity there and you were able to come out looking well. What kind of assets were you actually buying at that time?
Yeah. I mean, part of it was beginner's luck, if you want to call it that. But we were basically buying, beat up, boarded up houses from the bank direct, all cash. Single family. Yep. And small multifamily, 12 units or less from, call it 2008 till 2012, that period of time where you could buy things at 50, 60% off what they were previously sold for just a few years prior. So, it didn't take a genius at the time to know that you could buy low. And at the same time, we were very picky in particular and nervous and scared. The wheels were falling off the bus around us in many different markets, industries, areas. And so it was a scary time for sure. A lot of fear and uncertainty. But, some of the buys back then, you'll never see those prices again, of course.
Yeah. But every single market has its opportunities. There's always opportunity out there, including what we're in today. So since then, you guys have kind of shifted from the active investor GP model where you're going out, buying your own deals, and you focus more on the private equity side where you're placing capital. Tell us about that transition. How did it go? And what were some kind of insights that you learned along the way?
Yeah. So, I'll mention this. We were active GP from formally 2010 till 2017 on just about every deal that we provided our investor network. But at the same time, myself and some of my family members were diversifying our own personal capital, Gabe, as LPs into other deals, right? we got into mobile homes and self-storage, and we invested in honestly about a dozen different asset classes within real estate, including oil wells and student housing and vacant land and short-term notes. We did that from 2010, 2011 till 2017. So we had built up, kind of two business models. One formally was an active GP, and then also with a personal and capital as LPs. And we just compared and contrasted risk, reward, operators, sponsors, real estate sectors. We had a good amount of data that we could essentially pull a thesis from for the next 10 years or so is what we were thinking. Because in 2017, there was a lot of writing on the wall that, perhaps the low hanging fruit that we had been buying in the single family, small multifamily space was, coming to an end, right? Those deeply discounted foreclosures, REOs, short sales, margins were getting squeezed, competition was increasing. And so we pivoted to what we continue to do today, which is partnering with operators in different asset classes that we know, like, and trust, and raising capital from our investor network, either as an LP or co-GP or JV structure, really with the focus of diversifying, right? We wanted to spread our risk out across people, different operators, geographies, real estate sectors, strategies, income, growth, you name it, really with a more of, I would say, a lower risk strategy. And so that's consistently what we do today as well.
Nice. So you mentioned, you guys have a lot of data, like experiential data to pull from. You've done your own deals, and then you've invested in multiple. You said a dozen different asset classes. With all this experience, it's really good, for the listeners and for anybody just starting out or who wants to improve their own operations, to hear what were the best elements of all the different, asset classes that you saw. Which ones kind of stood out to you as the ones that you prefer and that you see really long-term growth with, and which ones are the ones that you're like, I'm going to stay away from those. I've been burned too many times.
Sure. I'll start with what we stay away from, Gabe. The list is a lot longer, but and really it comes down to risk versus reward. And so we're constantly assessing risk, and risk comes in a lot of different with different faces. It comes from people risk, strategy risk, operating partners, of course, but also real estate sectors and whether or not they're correlated to the overall economy, the stock market, you name it. And so we try and find those that we think have the lowest risk with a very attractive return. So what we stay away from right now is new construction or development, high risk.
Interesting.
Not such high return, in my opinion, for the amount of risk that you take.
And I don't want to take over here, but it's interesting that you say that, because new construction is the thing that, at least from my, I've had 600 people on this show, and from my understanding of where a lot of investors stand is that they see new construction as kind of the gold standard for returns, in terms of, like, if you want to get, 30 to 20 to 30% IRR, you're doing new construction. But you feel like the risk that you take in investing in new construction outweighs that potential return that you could see.
I do. Yeah. Predominantly, I'd say the last couple of years, obviously interest rates have gone up, and the amount of development risk out there from, an execution strategy, right? When we always look at a deal, Gabe, we ask ourselves at the end of the due diligence process, do we feel a lot of conviction that this deal has a very high likelihood of meeting or beating the projected return? And we constantly find ourselves saying no on many of the new construction development deals out there. And so that's essentially how we think. Also importantly to note, we do have a focus on income. We like to have passive income. We like to have cash flow. Distribution starting in year one. And so doesn't mean we won't do a development deal just because of that, but it just doesn't really go into our buy box for some of these reasons.
Yeah, no, that is my hard and fast rule. If I'm not making money on day one, then I don't want to buy it. So makes a lot of sense to me.
There you go.
Awesome. So I jumped in there. We were talking about the deals you stay away from first, and then we're going to go into the ones you like the most. So keep going down that road. New construction, number one, you stay away from those.
Yeah, I would say office for obvious reasons. We also haven't invested in office over many years for a lot of reasons, but again, risk reward profile. Student housing, lodging, hotel, motel, Airbnb, indoor malls. I mean, those are a few that we don't pursue.
Really? Airbnb and hotel motels, that again is an asset class. A lot of people like it. A lot of people have been flocking to it, but it's one that you don't see the risk reward ratio.
Yeah, we have trouble getting comfortable with, kind of more of the sporadic revenue and demand cycles, seasonality trends, short-term user needs versus more of a longer-term user need. And so the ups and downs are a little less consistent in lodging, hotel, motel, Airbnb. And some of them can have higher expense ratios, less cash flow due to that, just based on the way they're structured and operating expenses being higher than other sectors that we do pursue. And so doesn't mean you can't do well. You can, but we just find that they come with a little higher risk than the preferred sectors that we do focus on.
Okay. So if I'm checking off things in my head, the ones that you have not touched on yet are multifamily, industrial, mobile home, RV, self-storage, and then all of the kind of the niche ones that I'm sure you guys don't even consider, like recreational golf courses, that kind of stuff. So was that exhaustive of your I don't buy list, or are there more in there?
I mean, there's definitely more, I would say, nuanced niche sectors that we probably won't get into either, just because of lack of understanding of them completely. And also maybe they're much, much smaller segment of the market. And so you don't know if that segment is growing or shrinking. We try and always look at our exit. Hey, in 5, 7, 10 years, when we're going to sell, are there going to be more or less buyers for this type of real estate? And we try and stay away from those that are going to be less. And so that's a big part of it for us. But yeah, as far as those that we do invest in, Gabe, you hit on a bunch of them. We'd also add in, private real estate debt is another one that we focus on as well.
Okay. So there are, yeah, like I said, the ones remaining, we got industrial, mobile home parks, RV parks, self-storage facilities, multifamily, and strip center retail. So of those, give me your two favorites and then tell me why you like those the best.
I mean, mobile home parks, number one. And then I would say number two is probably tax exempt apartments or tax exempt multifamily.
Tax exempt. Somebody came on the show and was talking about that, and my brain was exploding with how that actually works. So by tax exempt multifamily, you're talking about subsidized housing that gets a tax break because they've invested in low income housing in a specific area. Is that correct?
Partly correct. Yeah, it's not necessarily subsidized, and so you basically, when we say tax exempt, it means the property doesn't have to pay property taxes. And so a portion or all of it, depending on how it's structured. But basically what they are for us, Gabe, is a public-private partnership where we're creating affordable housing. So 50% of the units at the building are kept affordable by definition. It's a formula based on area median income. And each year, area median income changes. It's published based on zip code and location. And you have to keep half your units affordable to the local population there. And by doing so, you get a 50 to 100% property tax abatement, usually for 99 years, transferable to the next buyer. So you can see, attractive multifamily deals in growth markets, already stabilized, 90, 95% occupied at acquisition, where you can get, higher yield day one because you're basically eliminating or reducing your property tax payment, which is, of course, one of your highest, if not your highest expense line item. And so it's a niche within the niche, right? And so we love that space. You get very favorable financing too, Gabe. Freddie, for example, has specific loan programs for affordable housing. Lower interest rate, better term, interest only for 7 to 10 years only, fixed. It's great. So we like that space a lot.
So both of those two, your favorites, top asset classes that you like to invest in, mobile home parks, and then tax exempt multifamily, they both have to do with affordable housing. They have to deal with lower income housing, which is a big need in the United States. I'm assuming that is the common thread that you guys like to pursue. Yeah,
I mean, this has been a long-term thesis for us for many years as far as the lack of supply of affordable housing. I mean, it's massive when you think about truly affordable. Every state has a lack of supply in affordable housing. These are just data trends that we have been watching and tracking for many years. But and then you look at the amount of people who can and can't afford to buy a home, and it's just going in the direction that is unfavorable for most people, of course, because everything's becoming a lot more unaffordable. And so we think this is going to continue for better or worse. And, Econ 101, supply and demand imbalance, it's where we like to focus a lot of our attention on investing.
Yeah. Yeah. I'm, this is a total aside, but I've just been considering and thinking about how AI is going to be impacting the economy in general globally, because it's going to create so much more productivity. And eventually I feel like the only way to keep people housed is to provide basic income, basic income to pretty much everyone, which I'm very against. I'm a very capitalist person. I don't feel like the government should be handing out money, but it feels like that's the way that it will trend. But anyways, that's a complete aside. So one question, mobile home parks, that's what I buy. And so I know a lot about it.
Sure.
We also buy RV parks. That's something that we are really interested in. I did not hear that on your list. So I'm curious what your position is on RV versus MH.
And we do have some exposure to RV, Gabe. I'll just say we tend to not seek it out only because it's a smaller, of course, sector of real estate. There's less buyers for it when we go to sell. I also think for what we have invested in, what we've seen in our analysis, it's more transient based, less consistent monthly revenue. It's a little more volatile throughout the year. And so that's part of the reasons why we don't focus too much on RV, but we do invest in it from time to time.
Yeah, that makes sense. We really like RV, but because we like to operate it as a mobile home park, it's not as sticky. Obviously, you can't, it doesn't take $5,000 to move the home out of the park, but it does. We've been pretty successful at operating these parks, bringing in long-term stay people, and having, our average length of stay for our parks is over a year. And so, it makes a lot of sense. So mobile home parks and tax-exempt multifamily, you've already talked a little bit about tax-exempt. Talk about mobile home. Why is it that you like that asset? Hey guys, quick break from the show. If you've listened to this podcast before, you know we are always talking about how important it is to have the right mentors and partners in real estate, which is exactly why I've opened up the Real Estate Investing Club online community. It's a place for active investors to learn, collaborate, and get real deals done together. And right now, it is 100% free to join. We host weekly calls where we review deals, talk strategy, and share tactics. Just click the link in the description below and come join us.
Yeah, I mean, there's lots of reasons, but I'll start with, we've been investing in it. We started passively as LPs in 2012. And if you were investing in MH back then, gosh, I mean, it was like 10% preferred return getting paid day one, and going in cap rates were high, very high, 10%. You could buy mobile home parks that had, 100% of the homes owned by the tenants, no park-owned homes. And there's a lot of them out there. The space has since become very competitive, as you know, I'm sure, Gabe. Cap rates have compressed pretty significantly. And so there's pros and cons there as far as, where the sector is in its life cycle from an investment and equity standpoint. But at the same time, some of the underlying fundamentals that make it so attractive are there and likely not going anywhere. And so one of them, of course, is lack of supply. I'm sure you speak to many of your investors about this, but very hard, if not impossible, to build a new mobile home community in a desirable location that is actually affordable for the tenant. And so you have a moat around the sector from a new supply risk, which is kind of the opposite of self-storage. Although we love self-storage, it's very easy and low cost to build new self-storage. The new stuff competes with the old. And so mobile homes tend to have a pretty favorable, somewhat unique supply moat around the space. And so that's a big part of it for us. And then, of course, we talked about affordable housing, be able to provide that to the local community. It's a big part of our thesis, ongoing, 10-year plus cycle. We think there's going to be consistent and growing demand in mobile home parks. We continue to see that. And then you can look back, like there's this great chart, Gabe, that got me into mobile homes, I don't know, 12, 15 years ago when we first started looking at it. Equity Lifestyle Properties it's the largest mobile home park owner in the country. They've got this chart that they've been producing. It goes back to like 1985, 1990, shows net operating income per year, all the way up through, I think the most recent one is Q2 2025. And it shows you the NOI during good times, bad times, every single year. And you can see the low correlation or almost non-correlation of mobile home parks to the overall economy, right? So you look at the 2000 .com bubble and crash, you look at 08, 09, and you look at 2020, and you look at the last couple of years, and you see they compare it with apartments and other REITs. And when other real estate sectors are down from an NOI standpoint, mobile homes continue to chug along and have positive NOI growth. And so we just don't see that with almost anything else, Gabe, that is that consistent of a producer of NOI growth, even during, economic downturn. So that's a big one for us as well, of course.
Yeah, that makes a lot of sense. And I'll add on to it. You were mentioning that a lot of municipalities don't want to allow additional parks to be built. But I'll add on that we've even tried to expand parks that we own that have additional acreage, and they won't allow us to add sites to a land that we already own that already has a mobile home park on it. And so it's ridiculous, but it is it definitely, like you mentioned, it constrains supply. And so it gives what's there a lot of value to the people that are renting from it. And so if you lose somebody, it's kind of easy to bring them in. I won't say it's easy. You do infill. At least what we've found, infill is very difficult because we can't get somebody to bring their mobile home in. You have to bring in a mobile home yourself, and you have to fill it yourself. And that's really that is where value add is for mobile home parks, at least from my perspective, is bringing units in and then selling them on contract. It's a lot more difficult than it sounds, to be honest. We've been trying it, and we definitely haven't mastered it yet, but it's
sure,
that's where it's at. All right. And then so I just lost my train of thought. Oh yeah, we were talking about not building only, and you were talking about mobile home parks being asset or recession resistant. They say that also about self-storage, but I have not found that. We own, we were owned just at the beginning of last year. We owned 5 self-storage facilities, and we've been selling them after they've kind of hit stabilization rates. But we have not found the recession-resistant asset class. Haven't found it to be recession-resistant. When people aren't moving, you lose occupancy. At least that's what we found in our operating of these assets. And they're not, when mobile home parks stay full, you don't really lose occupancy in an up cycle, down cycle. They always kind of stay full, but we haven't found that to be true for self-storage. Have you found the same?
Yeah, it's interesting. There's some data that shows self-storage REITs in 2008 that were up, I think 5%. When everything else was down 30%, Gabe. And so during that downturn, they were definitely recession resistant, which is where I think a lot of the term comes from for self-storage. And if you think about it, the demand for storage comes when somebody or a family has a change of life. What does that change? It's a change of job, career, moving, downsizing, whatever it might be, that increases the demand for storage. But what we've seen over the last several years is that change has reduced, right? People aren't moving as much. People are not changing jobs. They're not necessarily increasing the demand for storage. And we've had a lot of new supply come online. So when you couple those two things together, the self-storage market has been soft for the last few years, to say the least. There's been rental rate declines, occupancy declines.
And overbuilt, the people just in Texas is where we own most of ours. It's like they just build them left and right. It's like, guys, stop building these facilities. What are you doing?
Yeah, we've been invested, or we were invested previously in a market in South Carolina, Gabe, in self-storage, where there was um, a moratorium put on self-storage new construction in that specific city. And the municipality said, look, there's way too much self-storage being built here. No more is allowed. And so it doesn't matter if you have self-storage zoning approved. No. And so again, biggest risk in self-storage is supply, but also, the housing market has been stalled for several years. People aren't buying and selling. You got a lot of folks stuck in 2-3% mortgages long term. I shouldn't say stuck. I mean, that's a great place to be, but it reduces the amount of sellers in the market, which then reduces the amount of demand for storage. But we're starting to see it pick back up just a tad here, Gabe. We recently made a self-storage investment in the last 2 months, and so we're excited about it. I think everything goes in cycles and waves, and I think the worst is behind us so far in self-storage for the last few years.
That's good to hear. All right, we have run down the clock. Before we move on, I always like to ask, if you could just give the people listening one piece of advice in their real estate career, what would it be?
Yeah, I mean, I would say if you're an investor looking at a lot of deals, don't believe the pitch deck. All right. There's a lot of information, but that is a marketing tool. You have to be able to do a lot of due diligence and deep dive into what's actually happening under the hood. And so it's a big one for us. A lot of people just take the OM and tend to make decisions based on that. And so I would say do a lot more homework, do a lot more due diligence, make sure you understand the risks and the likelihood of executing on the business plan, whether it is high, low, or not at all. And we've seen all of the above.
Yeah. You and I were actually just talking about this beforehand. I just sold one of our self-storage facilities that kind of went full cycle. And so we have about $1 million that we need to do a 1031 with. And so I'm going out to brokers and I'm like, hey, send me your deals. And I just threw this deal, this OM that I got into Perplexity. And I said, underwrite this aggressively and give me the gist of it. And it came back and it had all these red flags that it knew about the local metro, about, the specific, the P&L, all this stuff. And it did it within 5 minutes. And it said, this is overvalued by 40%. The real value is X, Y. But it really cuts down using these AI tools. Perplexity is what I used. For the initial look, the initial pass on a deal, it is so amazing, and I'm very happy that they're so accurate these days that it can kind of cut down on that review time. All right. Well, with that said, it's time to jump into the quick question round. Are you ready?
Sure.
All right. Starts with education. It could be any form. Could be a book you've read, a conference you've gone to, mentorship program you've been a part of, anything like that. I just need one recommendation that you would recommend people to advance their real estate career.
Yeah, I would say Investing in Real Estate Private Equity is a book that I find to be very well written by Sean Cook. It just talks a lot about the structure and fundamentals of private investments, Gabe. Some of the math underneath the hood that you got to look out for, really for LPs and GPs, and kind of a bit more of what's norm as far as deal structure goes, and something we focus a lot on when we're looking at our investments. Nice.
All right. Next question is for your younger self. Let's go back to the Mark who was still working in finance back in, I think you said 2008, 2009. Go back to him, look him in the eye, give him one piece of advice moving forward.
I would have taken even more action, honestly, Gabe, earlier on in my younger career. And, in your 20s, for example, it's easy to just have a great time and work that W-2, but take more action, attend more conferences, get much more educated, and do it as much as you possibly can, while still having a life, of course. And so I would say, just double down on education, taking action, and investing.
And that same sentiment has been echoed across so many episodes. You're episode 600 and something. And whenever somebody says something along those lines of, I wish I got started sooner, or I wish I did more back in the earlier days, I always like to point it back to you, the listener. If you are listening to this episode and you haven't done your first deal, just go get it done. It doesn't matter what it is. It could be a, single family house, mobile home park, piece of land out there, but just get a single deal done, get that ball rolling. 10 years down the road, you're going to be happy you did. All right. With that said, next question is about the U.S. It's a big place. There is a ton of opportunity out there. Give me the single metro you're most excited about investing in today.
Gosh, I don't have one, Gabe. There isn't a single metro. And the reason why is because we invest in about 36 states nationwide.
Oh, wow.
Yeah. So we
more than half the country.
Yeah, it's a lot, and it's on purpose. But we look at 2 to 3 deals a day. We invest in maybe 6 to 7 a year. And so 99% of the deals that we see, Gabe, we don't invest in. And so for us, it's not necessarily, hey, we just want to go invest in, Fort Worth, Texas. That isn't how we think. There's so much more to it than just location. A lot of the investments we invest in are portfolios of properties. And so we like diversification. It really helps reduce lots of risk, of course. But if I had to say one thing, I would say, long term, you probably aren't going to go wrong in Texas. Dallas, Houston has a 2 good
Texas
areas.
Triangle.
Yeah, exactly. So trying to give you something there to work.
Yeah, no. It sounds like you guys are deal first, location second, which makes sense, provided the location is a good one, obviously. And I just want to call out the metric that you just mentioned there, because it's worth noting. You said you review 2 to 3 deals a day, and you invest in 6 to 7 a year. So let's take the higher end of both of those. Let's say you take 3 a day, 7 a year. That means that you invest in 0.6% of the deals that you look at. For everybody who's out there who wants to get into good deals, it takes more than you think. You're going to look at a deal and you're going to be bummed that it didn't work out, but that's okay, because that's part of the game. Looking at all these deals, underwriting all these deals, and finding the good ones, the gems out there. Anyways, that's an aside. I just wanted to call it out because it goes to show the volume that's required to find those gems, those good deals.
Definitely.
All right. Next question is about lessons learned. Not every deal we get into goes the way we expect it. In fact, pretty much every time something goes wrong, and that's when we get to learn a lesson. So what was the deal that went a little bit sideways for you? And then what was the lesson you pulled from it?
Yeah. There's several, Gabe. That's what I'm trying to think of which one to give you here. But we've had properties burned down. We've had, a tenant almost blow up a property by leaving the gas on, locking the doors on purpose. She was foreclosed on. She got evicted, and she got arrested for that, of course. So we've been through a lot of hurricane damage, flooding. This stuff happens when you invest in a lot of properties. And so I wouldn't say there's any one specific deal. I just say that there's always a challenge, literally, in this business, always, from market risk, recessions, drop in values, rents. We talked about self-storage, and that's kind of organically came down the last several years. Storms are a big part of it. We love Texas, but you got to be careful. And so we've worked through a pandemic, of course, interest rate hikes, fastest rate in 40 years. All these are challenges. This is part of what makes what we do hard. But if you have a strong spine and you think you're a really good problem solver and you're in the business of problem solving, you can be very successful as well. And so I'd say to overcome these challenges, build your inner confidence, make sure you're working with a really reputable, highly experienced team. That's a big one for us, Gabe. Our sponsors and operators that we partner with are just, most of them are just damn good at what they do. We'd rather invest with them than try and compete with them. And so that's kind of our motto on how we look at things. And just remember that if you're with the right team and you never quit, you'll get through the difficult times.
Yeah, I like that. All right. On the other side of that, sometimes deals just go right, and it stands out in your mind as one of your favorites. Take us to that deal for you. Which one was it?
Sure. I think the first one that comes to mind is during the pandemic, right? And I'll mention this. In March of 2020, we were raising capital for a 2-property strip retail portfolio. And we were already investors in these properties personally. And there was some equity that came available. And so we were raising it from our investor network. to invest alongside us. Now, then COVID hit. It was in the middle of the capital raise. And so we paused and returned our investors' money to them and didn't have them invest in the deal. And then we waited about 6 months before doing anything as far as investing. And, we tracked our portfolio, our operating partners' portfolios, tons of data. It was a scary time, of course. But by the end of summer, we started realizing that there was a lot of tailwinds happening from a rent growth standpoint, from a cap rate compression, from high demand from buyers. And so we made our first investment in August of 2020 into an apartment community in Phoenix. It was a income and growth investment, so provided positive cash flow, but also had a renovation plan. Our operating partners were planning to renovate 30% of the units and then sell it in 3 years. They renovated about 20% of the units in the first 15, 16 months. Rent projections were much farther below what we actually were able to achieve because of the market tailwind. We underwrote cap rate expansion when we actually had cap rate compression. And so essentially we hit a giant home run. Our investors doubled their money in 18 months, 96% IRR to our investors. And it was a combination of great execution on the business plan, but also market timing, just to be transparent. That was something that we didn't project.
Well, a lot of times when I ask this question, luck is a big factor. But hey, when luck comes your way, you take it, because half of everything is luck. You do all the work you can to prevent, poor luck from coming your way. But when the good luck comes your way, you take it. And it sounds like that was a good one there.
Definitely.
All right. Next question is about AI. This is kind of a new question that we've been asking. I try to implement AI in as many places as I can in my business responsibly. So what is a way, or first, do you use AI in your business? And then how do you do it? And how can you suggest people use it in their own?
Yeah, I mean, we use personally ChatGPT and Perplexity are the main two, really, for lots of reasons, Gabe, right? It's analysis, research, and even just writing. There's a lot of different ways to utilize these tools that we're just scratching the surface on, to be honest with you. Underwriting is a big one. But then you also have a lot of software that's coming out and has recently come out for property management across different real estate sectors like apartments and self-storage. And, I would say, think about dynamic pricing, right? What is the value, or what is the market rate of a self-storage unit today at 123 Main Street in this city? And it's been around for a few years, but it's getting really attractive to have these types of softwares implemented at the property level for leasing, rental rates, determining what your competition's doing down the street, and being able to adjust pricing by the hour if you want to. And so think about the airline model and the hotel model. It's very much happening and has been happening in different real estate sectors, from property management. And then also for screening, there's been a lot of fraud on tenant applications. That is growing. That's one of the negatives of AI, is you may have a fake person with a fake pay stub and a fake everything, and you may not be able to tell. And so there's AI that battles against that as well. And that's been implemented across many of our projects to help make sure that you're renting to people with valid incomes and backgrounds. And so that's another big part of it as well. Nice.
All right. Well, that leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
Yeah, I think the best place to start is our website, smkcap.com. Again, our company is SMK Capital Management. I would suggest everybody to join our investor network. It's something you can do that gets you learning about how we look at the real estate market. We share a lot of education and content on updates in the market, what we're investing in and why, what we're passing on and why. underwriting, due diligence, really just a great spot for people to learn more about us and also what we do and why we do it and how. And then, of course, reach out if it's you think it's a good fit and you're looking for some passive investment alternatives. That's our specialty. We work with accredited investors. We've been doing this for 15 years, and it always starts with a phone call, a Zoom call, asking questions of folks. Why are they even interested? What are their goals, Gabe? That's the big part of it for us. And then seeing if there's a good fit and taking it from there. So that's how I would suggest folks connect with us.
Perfect. I will put that link in the show notes. So if y'all want to reach out to Mark, all you got to do is click the little more in the description. It's going to pull down that full description, and in there you can find his links. All right, man, that wraps it up. Thank you very much for hopping on the show.
Yeah, thank you, Gabe, for having me. It was fun.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe, at therealestateinvestingclub.com. If you guys want to support the show, just leave us a comment, a review, anything like that. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.